Hello, everyone. Thanks for joining and welcome back. Our guest today is a good friend of ours, Peter Bookvar. Peter is the Chief Investment Officer with One Point BFG Wealth Partners. Welcome back, Peter.
Morning, Ivan. Great to see you.
Yeah, good morning. It's really great to see you and have you on. I want to say thank you so much for coming to speak to the silver and gold community. First question I have for you is, in your view right now, what are the biggest risks facing the U.S. and global economy right now?
I think it's very lackluster growth right now. In the US, growth in the first half of the year was about 1.25%. I don't see much improvement in the second half, particularly as the tariffs work its way through the supply chains. Overseas growth relatively muted as well. So to me, that's my biggest concern. In addition to that, even in the face of that, we have central banks that are cutting short-term interest rates in response to that sluggish growth. And Jay Powell told us that he's going to do the same in September. But we're seeing this pretty persistent rise in long-term interest rates. And I think that should not be ignored by markets. The UK 30-year gilt yield trading at its highest level since 1998. The Japanese 30-year yield at the highest level since it was first issued in 1999. The French 30-year yield at the highest level in 14 years. The US 30-year yield approaching 5% again, and only about 15 basis points from the highest level since 2007, I believe. And if that continues, it can then drag up 10-year yields and can then totally offset the benefits of lower short-term interest rates.
Hello, my silver and gold bugs. I just wanted to say thank you so much for watching the video. Hit the subscribe button, hit the like button, and also hit the notification bell so you don't miss any future uploads. Back to the video. Do you think Powell is making a mistake by, well, if he does lower interest rates in September with inflation still relatively high, do you think that would be a mistake like what happened in the 70s when Volcker lowered interest rates too early?
Well, I think if he cuts once or twice, fine. The labor market is softening too in the US, so I give him that, and I mentioned the 1% growth. However, if it's more than that and it's more pronounced than that, just because they want to lower interest expense, for example, for the government, then yes, the inflation risks do rise a lot. So I think for now, we should be expecting in what I refer to a rate tweaking cycle rather than a rate cutting cycle. But if it turns into more of a rate cutting cycle, separate from what the data deserves, then yes, you're looking at much greater risks for higher inflation. You're looking at a leg down in the US dollar, which could then exaggerate those inflation risks. So yeah, from here, I'll give them again one or two, but if it's anything more than that and the data doesn't deserve that, then yes, you're looking at greater risks here.
In this current, economic, financial era that we're in right now, 2025, where can you make money? What commodities do you have your eyes on?
So we're long, in addition to gold, silver, but also platinum. We're very bullish on, uh, both because of its big discount relative to gold, but also the world realizing that full-on EVs is not the answer, and that hybrids make a lot more sense, and many hybrids actually use more platinum than an internal combustion engine. We're pretty bullish on ag. When you got corn at $4, you got soybeans at 10-ish. That's pretty cheap to me, and you can buy the fertilizer stocks at, to me, really reasonable valuations at the bottom of a cycle. Still bullish on uranium, which we've been for years now, and I'm very bullish on oil and gas stocks. I think oil at 63, $64 a barrel in nominal terms is dirt cheap. So we like that as well.
Let's say you take someone on the street who's never ever invested before into any commodities. What would be your first step, you tell them when they're getting into this market?
Well, I would remind them that they have to have the stomach for volatility, because if they don't, then I don't recommend them investing in commodities. So I'd have them buy Coca-Cola and Procter and Gamble. So it really depends on that sort of gut that you have for volatility in markets. And also, commodity investors have to understand that they're cycles, and the cycles tend to be very pronounced, both on the upside and the downside. So it's not a buy and hold, close your eyes forever type trade. We know firsthand So I think that investing in that space, people have to understand that there are different economic dynamics and cycles there relative to other parts of the market.
Do you remember, Peter, when you first got into the silver and gold market, and what triggered you to get into precious metals?
Well, I've always followed them. I followed them, my career started in the early 90s, so I followed them through that time frame, but I didn't really get it excited about it until we saw, 250, $300 price of gold. And down from where it was 20 years prior, being a value investor and looking at things that are beaten up, that was right at my bailiwick. And then obviously the tech bubble and Greenspan cutting interest rates to 1% just further focused my lens on it and followed it very closely ever since. Have followed the Fed my entire career, worked for an ex-Fed, Fed governor. So when it comes to monetary policy and the financial system, I follow it very closely and have for many years.
What was it like working for the Fed governor? What did you learn?
Well, at the time he was an ex-Fed governor and remained so. It was Larry Lindsey, who was a governor in the mid 90s, but got firsthand learnings on the inner workings of what did go on there and how they view policy and not just in the US, but um, we followed closely the monetary policy initiatives of the European Central Bank, the BOJ, the Bank of Canada, the Bank of England, and so on. So, just how they think as human beings, because that's what they are, making real life decisions, but obviously with the assistance of their econometric models. But it was it's sort of an inside baseball look at what goes on there.
There's about $15 trillion worth of physical gold in the world sitting there costing money rather than being used is just absolutely insane. Monetary Metals is bringing gold back into the financial world, putting gold to productive use right now. The problem with gold, of course, in physical form is that it's heavy, it's cumbersome, it's not particularly easy to ship, and it costs money to store in a protected manner. This platform Monetary Metals created is a proven concept and allows gold to be put to productive use. So instead of sitting there costing you money, it's actually in use earning you money.
Learn how you can earn 2 to 5% in our leasing program and how accredited investors can earn up to 12% on silver paid in silver. This advertisement is not investment or financial advice. Minimum investment applies.
What about the debt servicing on all the U.S. debt? A lot of people are talking about how it's unsustainable, of course. Will it keep on increasing? What are your thoughts on that, Peter?
Well, it's unsustainable in the sense at a point which the government can't find enough buyers. But because they have the Federal Reserve as essentially an arm of the government, in a way they'll always find more buyers. But I guess the question is at what price and what the differential is between what your private sector demand is versus your potential public sector demand. We know over the last 20 years, actually more like the last 10 years, that we've had to rely less on foreign buyers to service our debt, or I should say to buy our debt, and more so on domestic buyers, where domestic holders of U.S. Treasuries total about 70% of total marketable debt. That percentage is only going to increase. So it's just a sort of where that clearing price is really what the main question is here.
Now, what do you think would collapse first, and maybe next now for the next 100 years? Would the U.S. government collapse first, or the Federal Reserve go away first?
Well, when you say collapse, I am hopeful as an American that it will not be the U.S. government that does. Um, as we've already seen multiple iterations of our central bank, then more inclined to pick that one.
Right.
But the Fed needs to change its ways. I mean, the Fed for the last 25 years, um, has well, actually more than 25 years, probably going back to the 80s at least. Well, even past that, the Federal Reserve has played God over interest rates.
Hmm.
And I don't want a bunch of people sitting around a mahogany table in Washington, D.C. playing God with interest rates. I am more of a fan of the markets setting interest rates on a daily basis, particularly the overnight rate. How they would do that, I'm not sure, but it sure would beat a bunch of bureaucrats doing so. And markets get things wrong at times. But the beauty about markets is that markets adjust much quicker than a bunch of bureaucrats do.
Absolutely. Now, Peter, before you go, I really want people to connect with you. I want them to connect with 1 Point BFG. I'm going to put the link in the description below. Where can they connect with you?
Well, on the wealth management side, they can check out our brand new website, 1pointbfg.com. And with respect to my daily commentary and writings, they can go to Substack, type in my name, and it's titled The Book Report.
Well, Peter, it's such a huge pleasure. I really enjoyed today's interview, and I think there was a lot of wealth of knowledge there people can pick up on. But thank you so much for coming down. It's such a huge pleasure. Yeah, I just want to say thank you, and everyone watching this, please check out 1 Point BFG. I'll put the link in the description below, and would love to have you on in the future, Peter.
Always a pleasure. Thanks, Ivan.
Talk to you soon.
You too.